Welcome back to Strongman Personal Finance. We got a sponsor video today. That's right. And if you want a sponsored video, see the pinned comment below and I'll talk about whatever you want. I don't do stock price predictions and I don't do valuations. Also, check out my tax preparation services for 2024. I am a certified public accountant and I will gladly do your business or individual taxes. All states in the United States of America are welcome. So let's dive right into it. So we have this amazing video from the banking bros. Bro, I'm a bro. The 3-cup reminds me of Two Girls, you know what. The 3-cup setup. That's basically what it is, a bunch of poop. The save and spend system. So apparently this guy named J. I guess he likes dew all over his face. Of the cash compound is going to simplify whole life insurance into the 3-cup setup. As a former financial advisor for First Command Europe Limited, I will tell you, whole life insurance is a disgusting rip-off scam that is going to cost you potentially hundreds of thousands of dollars in investment returns for a crappy product that you basically can't use until you explode into a pile of blood like a Marine in StarCraft when he dies. So let's go ahead and see what old J-Do, my poo-poo, has to say. Oh, hip music, bro.
What's up, guys? It's J-Do of the Banking Bros here at the Cash Compound. I got a little demonstration I want to give you today, and we're going to talk about whole life insurance built for cash for you. There's a lot of confusion out there in the world about what's going on, so let me give you the facts right here and right now. First off, there's a lot of different types of insurance. Life insurance is one of them. It's not car insurance. It's not fire insurance. In both of those cases, we hope we don't have a loss. But in life insurance,
oh, really? Life insurance isn't car insurance? Wow, JJ, you're so smart.
You gotta die sooner or later, and that is the bad news. But there's a lot of good news here, and the good news comes in two forms.
Won't be bad news when you go away, bucko.
Number 1, cash. Number 2, guarantees. So we're gonna use these 3 cups to demonstrate the cash growth and the guarantees from a properly designed, dividend-paying whole life insurance policy from a mutual company.
Okay. First of all, whole life insurance is insurance that you pay your entire life, and as long as you keep paying the premiums, when you collapse and go to the next realm, your beneficiaries will receive the death benefit. So if you buy a $300,000 whole life policy and you pay the premium every single month until the end of your days, guess what? Your beneficiaries will get that $300,000. That's whole life insurance, as opposed to term life insurance, which covers you for a fixed term, 10, 20, 30 years, and then it expires, and you get nothing after that. Another thing I'll say is, it's not a dividend. What happens is you pay these companies, and they return some of the premium to you because they basically overcharged you throughout the year. And it's definitely not a dividend because it's not taxable. A dividend is generally taxable. But a dividend from whole life insurance is not taxable because it's a return of premium.
Step 1, you got to go to work out there and work hard for your money. I'm sure you're already doing that, and we need money no matter what we're doing because we got to spend it. No matter how old you are, for whatever reason, you need money to
Yeah, you got that money from the clients you scammed.
Pay for stuff. So if we're going to use this banking system, we've got 3 separate cups that we're going to be able to get money from, place money in, or figure out where the money's going. Let's take a look at bucket number 1 right here in this cup.
Where's the bucket for your freaking, whatchamacallit, your commission? Where's your commission bucket there, bucko? Oh, it's in your pocket right now.
We're going to drop in $20, and this is where we put our premiums. Premiums for everything else normally confuse us and make us sad because we lose money because we got to pay the bills. But in this system, we have 2 other cups that populate and grow guaranteed with cash when we put money in bucket.
Okay, the premium doesn't grow. Well, it does, but there's a caveat. The premium does change because, well, the premium stays level, but the cost of insurance goes up because the older you are, the higher the cost of insurance. And what the cash value does is it balances that out by keeping your premium level, by building a cash balance, which is eventually paid out to you as the death benefit. Okay? But the death benefit itself doesn't grow unless you buy more policies with your dividends. It doesn't grow at all. You pay your premium, the cost of insurance goes up over time, the remainder goes into the cash value. The cash value is there in order to keep your premium level. That's why it's there, because it kind of builds a bulwark and it keeps your cost of insurance from exploding, as you'll see in a little bit. Let's keep watching. But no, your death benefit doesn't freaking grow unless you buy more additions.
When it goes in this red cup here, we've got a cash value cup and we've got a death benefit cup. Okay, these are separate cups and you got to understand that from the company's point of view and what's available to you. Number one, I put 20 bucks in here. I worked hard for it. And there is an available guarantee in cash value in bucket number 2. That's the cash value cup, right? So I put money in this one, and as you saw, the insurance company took care of the other 2 buckets. Without this bucket, the other 2 don't happen.
No, part of your premium goes to the cash value. And that cash value over time gives you space so you're not paying more in insurance over time. Where's that freaking chart at? Where'd I pull it up at? It's somewhere on here. I was not prepared for that. Okay, let's look at this. Over time, Jesus, where'd it go? Over time, you pay a level premium. Your premium is never guaranteed to increase. Your cash value goes up over time because part of the money that you give the insurance company gets invested into the cash value. After the clown that sold you the policy gets a huge freaking fee. Okay? So you can see the green over time is going up because that's your cash value. And the insurance goes down. Why? Because the cost of insurance is going up each year. But since you have a cash value that's covering the portion of the death benefit, you don't need as much quote-unquote insurance coverage. But when you perish, you don't get the cash value. What you get is the death benefit. You don't get the death benefit and the cash value back. The cash value is there to basically be part of your death benefit payment. That's all it is. Okay? And the whole time your money's sitting there in a guaranteed account that's getting charged fees and is probably getting the same interest as a treasury. When what you could do is take money, buy a term insurance policy, and then invest the difference in your Roth IRA or your 401k and buy every stock in the world. Which would I rather buy? A cash policy guaranteed by one insurance policy or every company in the world? I don't know. Let's keep watching the buckets.
And they don't grow. But we've got $10 in here. In the first year, it's approximately half of what I put in here. That's pretty cool. And there's also, of course, a death.
No, in the first year, it all goes to freaking commission. So you get nothing for cash value in the first couple of years.
Benefit. Any whole life insurance policy at the outset is going to have a death benefit that's guaranteed, and it's here for us. So maybe $1,000 goes over here. I own this policy, and on day 1, if I died and broke contract, day 2, this money is available to my friends, family, church, or charity. So,
family, church, and charity. Oh, just like term insurance.
So they're better off already because we got this bad boy started. But this bucket is not for me. It's not my cash. I'd have to be dead if it's on my body, and I'm the insured person. So
yes, the only thing you can really take out is the cash value. You have to, if you take it out and you close out the policy, all you get is the cash value. If you borrow against it, guess what? That gets subtracted from your death benefit. You have to borrow your own money. You have to borrow your own money to get the cash value out of a whole life policy. How freaking stupid is that? I could buy a term policy and put the rest in treasuries by myself. I'm going to have to borrow from my account. What a clown, dude. A whole life is a scam.
As you can see, this bucket in cash is what is available to me, but I didn't put the money there. Let's pass a little bit of time.
I mean, yes, you did. You pay the premium. Part of it goes to the cost of insurance. The other part goes to cash value. You did pay that.
time here. So I'm going to work hard. Sun goes up, sun goes down. I'm doing the same thing, not starting a new business. I'm going to drop some more of my hard-earned dollars into the premium bucket. Red Cup, number one. And oh, congratulations, the insurance company took care of me, and they have guaranteed cash value available to me.
Why is the death benefit going up? I don't know. The death benefit doesn't go up. This is wrong. The only way it goes up is if you take the dividend, which is not a dividend, and you buy more paid up additions, basically. The death benefit does not go up. This is totally freaking wrong.
Based on what I put in this cup. Remember, what I put in here automatically populates the other two cups. We got more cash.
No, it doesn't. Oh my God.
Value available, as well as more death benefit. That's awesome. Now, I put in several dollars in here, and I got some money available to me. But what's cool about this over time is as I drop dollars in here, the insurance company doesn't just look at the $20 I worked hard for this past year, or maybe I'm paying it monthly this past month. They don't just look at that. They look at populating these on a compounding rate based on everything.
Wow, compounding! Oh my God! If I buy if I put my money in a 0.01% interest savings account, it compounds! Whoa!
I've ever put into this cup. So as I put $20 in my next mode of payment in here, you can see I've dropped in money, $20, 4 times. They actually are populating the other cups with a guaranteed growth of more cash available.
Oh my God, this is the best investment in the world. Oh my God.
Based on all the money put here. So that's 20, 40, 60, 80. It's not just my 20 this year, it's all the money. It's called compound interest. And of course, that is the 8th wonder of the world. Einstein said it best.
Oh my God, yes, you can get compound interest anywhere. Okay? But it doesn't mean you're getting a good rate of return, especially compared to other opportunities out there. Why are you investing in cash that you have to borrow or close out the insurance policy to get access to? Oh, because it lines this clown's pockets.
Best. So we have more and more money available based on the fact that I'm only putting 20 in here, but they see all 100. So we've got cash value available, and we've got a death benefit. Now let's talk a minute about this cash value available. It's available, which means I am able to utilize this money throughout my life. And remember, saving is the hardest thing to do, not because it's hard to put money in this bucket. It's actually not that hard at all. It's because we need money to spend. So I still need money no matter how old I am, no matter what I'm doing. Doesn't matter if I'm 7 or 70, I need money. And this money is available, cash value available.
Yes, you have to either cut out the policy, end the policy, take the cash value, which won't grow as fast as you think, especially compared to market returns or even treasuries. Or you have to borrow against your policy. Borrowing your own money. What a clownish concept.
And of course, we've got a death benefit growing as well. But that's not the only money the insurance company puts in.
The death benefit's not growing. I'll say that 1,000 times, unless you buy more paid up additions.
I also mentioned that this is a mutual company. Now, a mutual company, as opposed to a stock company, will let the policy owners, the holders of these policies, and I said that was me, they'll let them participate in the growth of the company. And they do that through a bonus they call dividends, which they pay annually.
Wow, a bonus! They're giving you your money back. Go look at the tax treatment of return of premium. Look at this guy's eyes are bloodshot. Look at the tax treatment. If it was a dividend, they would tax it.
So each year, on top of the guarantee, they might also be putting dividends inside of my system. And when dividends go in my system, not based on my work or my effort, you can see that there's automatically going to be growth inside the other two cups. Why?
Yeah, they're basically charging you more. They're saying, oh, we're going to buy more death benefit for you. No. Do not do that. Don't have whole life insurance. It costs 10 times as much as term, and the cash value is hot freaking trash that you have to borrow to take out. What a deal.
Because the entire system is based on what goes in cup number 1, the red cup. When this bucket is full of money, it gets populated and puts money in the other ones. The guarantees come based on what happens on this bucket right here. So cup number 1, my red cup, the dividends from the company can be elected to go in this cup, which fills up all the other buckets in the game. So over the course of my lifetime, I'm going to work hard doing what I do.
I'm going to work hard selling garbage policies to people when they could just buy term and invest the difference in a total market index fund and a tax advantage account because it gets me commissions, scumbag.
And I'm going to drop as many dollars as I can in here, really. And what's going to happen to my cash value is it's going to grow compounded based on each of the individual
The eighth wonder of the world!
dollars I put in here over the course of my lifetime. That 20 that I put in year one or month one, the 20 that I put in phase 2 and phase 3 continue to grow. So do the dividends, which are non-guaranteed, but they're awesome. And mutual companies have been paying this for over a century, year after year after year. And this money, the cash value, is available to me. Remember, this money is...
How do we take it out, bucko? You don't tell me how I get my money out. I need more details. Come on, bruh.
Is here as well, but that money is not for me. That's the death benefit, and it's available to my friends, family, church, or charity. And that's cool, but I have to be dead to use it, so it's not for me. But this money here is available to me no matter what happens, based on what I did here. So we teach people at the Cash Compound how to save and...
He didn't mention anything. This is a grift, dude. This is a disgusting grift. These people are scum. But of course, you won't believe me. You'll go with him. Because he's got a nice voice. He's talking like a freaking dork, like Urkel. And he's got a nice background.
Spend money at the exact same time. What's cool about this system is that you're saving money here, but you're able to spend a compounded growth effect.
How are you saving money by buying insurance? And how are you going to spend the money? Tell me how I get the money out.
Of money in here. The Cash Compound is showing you
compound interest.
How to save your money and spend the insurance company's money in a properly designed whole life insurance policy built for cash that includes the growth of the dividends. That's a wonderful thing, and that's what we wanted you to know today. So we appreciate you guys reaching out to us and calling us and helping us help you understand what's really going on in these whole...
Okay, this was just full of errors, number one. And number two, even if he said everything 100% correctly, even if he did all the disclosures that he didn't do, he didn't give you all the details. I guess you have to subscribe and watch his stupid videos to get all the details. Whole life is not a good deal. The cash value does not grow quickly. When I used to sell policies, the first 3 years you didn't even accrue cash value because it was going to commissions for the advisor and the advisor's boss and the company that you work for. 3 years before you even started getting cash value. And then the cash value probably pays out the same rate as a treasury, which you could just get yourself. Okay? You got to borrow the money to take it out, or you got to cash out the policy. And the effects of inflation will massively diminish the freaking death benefit. Okay? Whole life is garbage. That's my sermon. Check out the pinned comment below if you want a sponsored video. Check out my tax services. Check out my book, Stop Being a Broke Loser. It's on Amazon. And you have a wonderful, delicious night. Cheers!